Now, there's a ton of information out there about home purchasing and endless amounts of questions and misinformation for first-time home buyers. So knowing what information to sift through and to know the answers to these questions can make a huge difference in the mortgage process and make it a lot less painful and less intimidating. So let's examine my top 15 most frequently asked questions when it comes to mortgage. Most first-time homebuyers will need to obtain a mortgage, and it can seem like a very scary process. However, when you're armed with just a little bit of knowledge about what you'll need and what to expect as you go from the mortgage application process all the way to the closing table, you can get rid of those fears and feel confident and comfortable with the whole process. So let's dive in. 1. Do I need great credit to get a mortgage? You don't necessarily need great credit in order to get a mortgage, but it will certainly help. It is possible to get a conventional mortgage with a FICO score, credit score in the 600s depending on different factors, or you could utilize an FHA mortgage as well for scores in the 600s if that conventional loan didn't work out. However, be aware that the lower your score typically means the higher your interest rate will be. On a $250,000 mortgage, the difference between a 620 credit score and an excellent 760 adds up to more than $86,000 in interest savings over the life of a 30-year loan. Another factor to know about with credit and with mortgages is that the lower your credit score is for conventional mortgages, the more expensive your mortgage insurance will be. 2. How much do I need for a down payment? The short answer is that you can get a conventional mortgage with as little as 3% down and an FHA loan with 3.5% down, while an VA or USDA loan can be done with no money down at all. We even have a portfolio program at my work that allows for a 1% down conventional loan option. There are also other options such as down payment assistance that can help lower the amount you'll need to put down on a home, thus allowing first-time home buyers an easier time qualifying for a home if they don't have the saved up capital. Remember though, with a conventional loan or an FHA loan, you'll have to pay private mortgage insurance, or what people refer to as PMI, if your down payment is less than 20% down of the home sales price. For conventional loans, those payments won't be a permanent fixture on your monthly payments, however. Once the loan-to-value ratio on your mortgage falls below 80%, you can ask your lender to drop them. And even without your request, lenders are required to cancel PMI when the loan-to-value drops below 78%. That does not apply to FHA mortgages, where that PMI, or in FHA terms it's called MIP, that stays on for the life of the loan. 3. What are closing costs and how much should I expect them to be? The term closing costs refers to all the charges you'll need to pay for before your loan is completed. This can include lender fees, title fees, prepaid escrows, and you know the state wants their money in the form of a tax. So closing costs can vary significantly state by state and situation by situation, but generally you can expect to pay around 2 to 3% of the home's price in closing costs. 4. Should I choose a fixed rate or adjustable rate mortgage? When interest rates are historically low, like they were, a fixed rate mortgage is a good financial sense investment, almost really the only choice at that point. Now, not surprisingly, the vast majority of mortgages originated in the last few years were these fixed rate mortgages. Now, that being said, while a fixed rate mortgage may still be the best choice for the majority of home buyers, there are some circumstances where an ARM might be better. For example, if you expect to sell the house before a fixed interest period of an ARM rate ends and the rate starts to float with the market conditions, an ARM could end up saving you thousands of dollars in the long run. Or during periods of falling interest rates, an ARM can allow you to get a low initial rate and then will save you even more money if rates continue to drop further on down the road. Now, essentially the way ARM rates work is, let's just say you have a 7 or 10-year ARM. So that 7-year or 10-year, it stays fixed. So it's a fixed rate in that time frame. And then after that time frame ends, it resets every 6 months and kind of like resets itself with the current market trend. So if you do an ARM, the idea is that you'll either stay in the home in that fixed period of time, you'll refinance out of it, or you're just hoping that rates will drop from when you purchase the home. Number 5, when should I lock my interest rate? A rate lock means that you're guaranteed that date's mortgage interest rate for some predetermined period. Now, it's typically 30 to 60 days, but it can be more. The longer the lock, the more expensive the lock is. If an interest rate has been trending upward, it's generally a good idea to lock your interest rate because then you're guaranteed a lower interest rate while they continue to go up. And it's typically not the rate that really moves per se, it's the cost for the rate. So rates do shift if the market changes enough, but the movements of pricing is more apt to happen. So as general rule of thumb, if you like the payment you're at and you're within about 45 days of closing, it generally makes sense to lock in your interest rate. Number 6, what type of mortgage is best for me? Now, there are several different types of mortgages to choose from depending on your credit score, your income, and really what you're looking to do. A conventional mortgage is tougher to qualify for credit-wise due to the higher credit requirement, but an FHA loan can be costlier. Both give options for multifamily units, though the requirements can be somewhat different between the two. If you're a veteran, a VA loan could be the best option for you as it gives you a 0% down option. And if you plan to buy a home in a rural area, USDA loan mortgage could also give you a 0% down option, but this program is a little bit harder to qualify for. Both conventional and FHA loans have options to have down payment assistance tied to them, though it's more common for conventional loans. Typically, sellers of homes and in turn list agents prefer to see conventional loan pre-approvals from you as a buyer. The reason that is because they view that as less complicated and less kind of hoops to fall through and less, problems that could occur. Number 7, what are discount points and should I pay for them? Discount points are money that you pay up front on your mortgage in exchange for a lower interest rate. Think of this as an additional closing cost. 1 point is equal to 1% of the loan amount, so on a $300,000 mortgage, 1 discount point would be $3,000. Discount points are currently tax deductible. Consult your tax guy. And mathematically, if you break even on your scenario, the discount point investment can make sense in terms of making you money back and then some. It can then be worth it. It's kind of like a snowball effect of savings. A conversation with a mortgage professional can help you determine whether discount points are a good idea by looking at the effect of various interest rates on your mortgage compared to what your overall plan and goals are with the home. So discount points really make sense if you plan on staying in the home or if it's something that you plan on turning into an investment property. Discount points can make sense. Now keep in mind, if you plan to refinance the home in a short amount of time, you want to make sure that that break-even point gets hit so that way you're not kind of wasting money buying discount points on a loan that you're going to end up paying off throughout from doing a refinance. Number 8, should I get a 15 or 30-year term loan? Whether you want to get a 30, 20, 15-year loan, it really comes down to budgeting and your overall goals. If you are the type of person that really doesn't like debt and wants to stay out of debt, this could be a good option. But it really depends on how much you want to stretch your budget. If you can afford the higher monthly payments, a 15-year mortgage usually comes with better interest than a 30-year version. Not only will you pay off the house quicker, but you can save a tremendous amount of interest. Now, on the other hand, a 30-year mortgage will cost less per month, allowing you to afford a bigger and nicer house or one in a better location. If you have a home with a lower payment, you can actually put money elsewhere to help grow it in other areas such as the stock market. There's no penalty to pay off a loan early or to put more towards principal, so you can mathematically change your 30-year loan into a 15-year by adding a certain amount to your monthly payment each month. The advantage of doing it this way with turning your 30-year mortgage into a 15-year mortgage is then you have the option to pay less monthly during a given month if you wanted to, compared to a 15-year mortgage payment where you're required to have a higher monthly payment. There are so many options when it comes to how you want to structure things after closing. And the most common example I can say for this is if you have a 30-year mortgage and you're paying it down like a 15, but then you had some unexpected, let's say, doctor bill, or you had to buy a new car or something like that, you can choose a month where you're paying less on that house, where if you had a 15-year mortgage, you would be required to make that payment. Number 9, what documentation should I gather? Now, your lender may ask for different items as each file can be a little different, but in general, be prepared to show the following. Going to need your last 2 years of W-2s, your most recent 2 pay stubs, and your last 2 bank statements from the accounts you plan to use for your down payment and closing costs. Documents can change slightly if you're on a commission job where you'll need to show 2 years of commission pay, so gather your most recent 2 pay stubs along with your last 2 years ending pay stubs, because then that allows us to see what your commission pay is year after year. This commission pay will be more than likely averaged over those 2 years. If you're self-employed, you guessed it, another scenario where we're going to need 2 of something. In this case, you're going to need 2 years of federal tax returns, business and personal, to figure out your average monthly income. We'll also need a current year profit and loss statement as well as last year's ending profit and loss statement. Now, the simplest way to answer this question is, what do you make, how do you make it, and what do you have in savings to use for down payment and closing costs? Number 10, what is a pre-qualification? So a pre-qualification is a basic review of your finances to determine would you qualify for a mortgage. Now, in general, a pre-qualification is based on unverified information that you provide and does not include a credit check or any documentation, typically doesn't even have an application, and therefore is not a firm guarantee on a loan. So think of a pre-qualification as the first step towards home ownership. It allows for the discussion of any goals or needs regarding a mortgage by going through various mortgage options and recommending that the type of mortgage that you might be best suited for. It gives you an idea of how large a loan you'd likely qualify for before sending in documentation, running credit check, applying, and all that kind of stuff. Pre-qualifications can be done with or without this application, but to make that pre-qualification into an actual pre-approval, which is what is needed to make an offer on a home, more steps are needed. The pre-approval would be that next step. Number 11, what is a pre-approval? Unlike a pre-qualification, a pre-approval can be a highly useful tool in the home buying process. It essentially is the same thing as applying for a mortgage, just without the specific home attached to it. Compared to a pre-qualification, this is what is needed to offer on a home. It builds off the pre-qualification with a completed official mortgage application, as well as supplying all the necessary documentation to support the information given in that application. Now, with a hard credit pull and supporting documents, we are then able to perform an extensive credit and financial background check. Going through the pre-approval process also gives a better idea of the interest rate, since we'll then have an official credit score at that point to go off of. In some instances, a pre-approval letter is needed just to see a property. This is also one of the first questions a realtor will ask you if you approach them prior to a mortgage lender. Think of the pre-approval as the gateway to offering on a home. Within a pre-approval, you may ask yourself, does it matter where I get it? It might not necessarily be about a better pre-approval, but more about the perception of the pre-approval to the list agents and sellers. Certain companies are better known for their pre-approvals and seemingly hold more weight in their offer as a result to the listing agents and the sellers. This is due to the perception that the pre-approval is worked through and has a higher likelihood of closing without problems. Being backed by a bank can usually help, as it is thought that there is more support in the process of the loan closing on time. With your pre-approval, it is important to find a lender that does not have many overlays to the federal guidelines. Overlays are additional requirements or guidelines in addition to those national standards by the banking institution. You may also want to work with someone who is available, personal, and up to date with the strategies to help you get an offer accepted. Number 12, what is an escrow account? When you obtain a mortgage, you'll probably be asked to put money into an escrow account to guarantee the lender that the ongoing expenses of owning the property will be handled, specifically the taxes and the insurance. You'll pay an initial lump sum into the escrow account at closing, also known as prepaids, and add to it further with each monthly payment you make. Think of this as a savings account for your house for when the taxes and the insurance are due. It is simply gets paid out of that account for you, and then it fills up when you make those monthly payments, so that way when they're due, there's enough in there for it to automatically get taken out. Number 13, why does it take so long to close a mortgage? So mortgages tend to take at least 30 days to close and originate, and many first-time home buyers don't expect much of a waiting period because they're used to an apartment where they can kind of just move right in. The short answer is that a lot of things need to happen between you submitting your mortgage application and taking ownership of the home. Just to name a few, you're going to need to gather all that documentation for your lender, as we'll always come back and ask for more. Believe me, I do it. And you'll want to schedule and complete a home inspection, which will take time, and there's a waiting period within that. The seller may need time to complete certain repairs, and the loan needs to make its way through underwriting and a title search, all of which take time. Don't forget, you also need to have an appraisal done, which gives the value of the home. Overall, it can be a lengthy process, but if you've done the work up front with your lender, it shouldn't be a stressful process outside of the fact that you have to move, which we all know can be one of the worst parts of it. Number 14, how is my mortgage payment determined? Depending on your situation, there are typically 3 or 4 parts of your mortgage payment. You have your principal, which is the repayment of your outstanding balance. You have the interest, which is the payment of the interest charged on that outstanding balance. You have taxes, which are 1/12 of your expected annual property taxes to be included in that mortgage payment when you escrow. And then a certain amount will then be deposited into your escrow account based on when you close and when your state collects its taxes. Then you have insurance. This includes homeowners insurance as well as any other hazard insurances you're required to have, such as flood or windstorm insurance. If you have flood insurance, you'll know how expensive that is. And then if you put less than 20% down on your loan, this can also include private mortgage insurance, which is insurance to protect the lender in case you go into default on your payments. So it kind of like, essentially you pay a monthly payment, and it protects the lender in case you don't make those payments. They can actually recoup their money on the property. Based on these 4 items, your mortgage payments are sometimes referred to as the PITI. It can also refer to as the PITI-A, which the A then stands for association dues if you live in a townhome, or a planned urban development or a condo. Number 15, will my monthly payments change during the loan term? Short answer, probably, but only by a little. Even with a fixed rate loan, your payment is likely to change over time. The reason? Your property taxes and insurance expenses, upon which the escrow portion of your payment is based, tend to fluctuate, and they really only go up because the state and county and everything want their money. If it does rise, it will mean that your monthly payment will increase slightly, not a whole lot, especially if you have a fixed rate mortgage. Then that actual mortgage part stays fixed and stays the same for the life of the loan, with the taxes and the insurance only slightly changing. And a bonus question that gets asked so often, especially with first-time home buyers, is how do I handle gift money? So gift money, think of that as money coming from family. It can't come from friends, but it comes from, let's just say, family or blood relative. That money, let's just say mom or dad are going to gift you $5,000 for closing. We ideally do not want them to transfer that money into your account. Rather, just know what that amount is. And so then what we do is we know what that amount is, we apply it to your mortgage qualifying, and we just have your parents hold that amount. And then when we get closer to closing or after you get an offer accepted, what we do is we have the parents do a cashier's check to the title company with that amount. So if the parents are going to give $5,000, we have the parents write the cashier's check to the title company on your behalf, and then you bring that check to closing. So then that gets applied to your funds. Then that prevents us from having to track down any kind of bank statements or transfers or anything like that. It just makes the process that much more clean. So if you do have gift money coming your way and you're going to be buying a home, just know what the amount is, know who it's coming from, family, blood relative, and we'll take care of that as part of the process. Another trick you can do is if you know you're getting money from family member, try and get that money at least 2 months ahead of time, 3 months before you start the mortgage process, because then it's considered seasoned money. So when we pull 1 or 2 months bank account statements, it won't show up in there as a deposit, and then that's considered seasoned money or your money at that point because we don't really see the difference. So a little tidbit for you if you're getting gift money. Hopefully this gave you some insight to these top questions, the top 15 with the bonus question at the end. There's a lot of stuff going on in a mortgage, especially for first-time home buyers. So consulting with a mortgage professional and really getting into the nuance of everything, it's very important. So educating yourself ahead of time is huge. So thank you for watching this video. If there's anything more that you have wanting to know or you have other questions, feel free to reach out. I use questions and comments as kind of a way to gauge what other videos I should make. So please reach out if you have any questions. Obviously, I'm here. I'm in multiple states. So if you're in a different state than what I'm in, I can more than likely help you in one way, shape, or form.